offer.
Do you research there too?
Absolutely. Then a great way to ease in is to maybe start with companies you're already familiar with. If you love Apple products, maybe your first investment is in Apple stock. It can keep you engaged, make the initial research feel less daunting than diving into some obscure industry you know nothing about.
So ease into it with what you know. What about broader, maybe more conservative options for long-term growth, not just individual stocks?
Yeah, for more conservative long-term growth, mutual funds are an excellent choice, especially index funds.
Index funds, you hear about those a lot.
Right. These funds hold tiny pieces of all the stocks in a particular market index, like the S&P 500, so you get really broad market exposure automatically, very diversified. Exchange-traded funds, or ETFs, are similar in many ways. They can invest in baskets of various assets too, maybe real estate, commodities, specific industries, bonds.
Okay, so funds offer instant diversification. What about balancing the portfolio? You hear about stocks and bonds.
Exactly. To balance your portfolio further and potentially reduce overall volatility, you'll likely want to add bonds. Bonds are generally less volatile than stocks and can provide a steady income stream through interest payments.
And commodities. I often hear about gold or oil as investments, especially when things get shaky.
Yeah, commodities like coffee, corn, crude oil, or precious metals like gold can sometimes act as a hedge against risk in other parts of your portfolio. Their value might increase when stocks are experiencing a downturn. Gold, for example, often goes up during stock market volatility as investors seek a perceived safe haven.
But proceed with caution there, too.
Definitely. And be aware that certain types of bonds, like high-yield bonds, often called junk bonds, because of their lower credit rating, carry significantly higher risk, though they offer potentially higher returns. It's all about risk tolerance.
Got it.
And finally, a really important point. Don't invest everything all at once. Grow your portfolio gradually. Contribute a little bit regularly, maybe each month or each quarter over several years.
Dollar cost averaging.
That's the strategy. It's called dollar cost averaging. It helps you avoid trying to time the market, which is almost impossible, and allows you to potentially buy more shares when prices dip and fewer when they're high, averaging out your cost over time.
Okay, this is where, for me, it's really interesting. What if the entire market isn't always efficient? What if it's not always right about a company's true worth? How can you possibly spot those hidden gems that maybe everyone else is overlooking?
Now you're talking about the fascinating concept of value investing, famously articulated by Benjamin Graham and, of course, championed by his student Warren Buffett.
The Oracle of Omaha.
Indeed. It's all about recognizing that Mr. Market, as Graham colorfully called him, can be, well, quite irrational at times.
Mr. Market. Explain that.
Graham imagined the market as this manic